Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Mike McGlone from Bloomberg. How you doing today?
I'm good, Darrell. Thanks for having me back.
Yes, indeed. Yes, indeed. So you've been calling for gold and silver to have some form of a correction or blow off top, whatever, however you want to frame it. And many people did not take a liking to that, and you were calling for that for a while, and that's what we got last month. And so just curious in how you're viewing this recent sell-off in gold and silver, and what do you see for the future of the metals?
I like how you describe that, because that's typically a sign that you're going to be right. Not taking a like to that. I mean, that's very profound, a liking to that. And it's kind of a thing I'm used to as a strategist. I'm out. I'm not involved in markets. I'm biased position. I don't have positions on. My compliance is minimum 30 days, and I don't trade. And I haven't, sorry about clearing my throat. But typically when people respond with things like that, with emotions to a call, it usually means you're tweaking something. And crypto people are classic for that. Metals people are a little more stoic. But the bottom line is you're supposed to be selling when they're yelling. And I think silver potentially has peaked for many years this year. Gold might be peaking for many years this year. Copper could be. Platinum's maybe a little different story, but all the metals are showing classic up too much risks. And of all those metals, there's only one that has the lowest autocorrelation of all commodities, and that's gold. The problem with almost all commodities, particularly silver, when it goes up at the velocity it has this year, is most prudent metals traders know and have learned either the hard way or the easy way, is you're not supposed to jump on. At least poor risk reward usually follow jumping on board parabolic moves like this. So I will make the call that I think silver, I already did already, silver will be down on the year. I think gold could be down this year. I think almost all the metals could be down this year. Predicated there on one simple little thing, just a little modest recovery in U.S. stock market volatility. Now, maybe we started that a little bit, but we have 180-day volatility in S&P 500 around 11%. The historical average, 10-year average is around 18%. Right now, it's about the lowest in 8 years. You have to, if you're long any type of metal other than gold, even gold now, because gold is the least industrial and it's not even industrial at all. Any industrial metal, silver is now 60%. If you're sitting with that metal position on I look at it my screens as an ex-hedge fund person, you should have that stock market right next to you. And if the S&P 500 is down 10%, most industrial metals, particularly copper, will probably drop 20%. And the key thing to remember about all the industrial metals is, sure, we've had this wonderful rally. Everybody gets the fundamentals, and I'm kind of annoyed by people keep repeating to me stuff that people like me spoke about many years ago. But when you shift prices this exponentially, it'll shift that supply-demand balance, put in peaks that might last forever. And silver is a good example. The devil's metal, I think, is peaked this year that might last for years. I think if it gets anywhere near 100, prudent traders will be shorting it. My suggestion this year was prudent shorts above 100. So far that's worked out. But I do like how you started out. It's always remember when people get emotional about a call, they have to remember you never should get emotional about a market and a position. You have to be stoic as much as possible. It's easy to say, as much as possible, particularly if you're running risk. I'm used to running leverage risk my whole life. I came from the trading pits. And so I'm making the call. I'm still sticking with my initial bias at the beginning of this year that stock market volatility will be up this year. It's still down. I mean, S&P 500 is essentially unchanged on the year. It's up about 1%. And the key best performer will probably be Treasury bonds. Now they're basically flat in the year too. So far, 0 and 0 at the moment, both those markets on the performance basis as we get to February 6th.
Okay, got it. Yeah, thanks for sharing that. So curious, and so obviously they've had a blow off top here this recent month. I'm curious if you see like a floor for the metals or whatnot. I know like in the prior bull markets when we've had like a blow off top, they would establish a floor. I mean, I don't think gold went below, I think it was 1,100 or maybe 1,000 back after 2011, the blow off top. And so just curious if you have any perspective on the floor for the metals.
Yeah, well, right now I'm looking, it depends which metal. I'm looking at, for copper, I already mentioned 50. And if I didn't mention, I think it's going back to 50, the old highs, at least initially. Gold, I think, is easily, gold could drop $1,000 in a heartbeat, get to $4,000, and it's still historically very rich versus most other measures. I mean, certainly versus itself, versus its 60-month moving average. Right now, we're 2.1 times the 60-month moving average, and there's many ways to measure. That's just one of kind of the basic standard. It's a 5-year measure. You have to go back almost 50 years to 1980, the last time we were this stretch, and we've never had a rally at this high velocity. I think I've mentioned this before, in gold and the precious metals with stock market volatility, inflation, crude oil, and things like that staying so low. And I think what it's indicating to me is that inflation, that volatility in stock market will pick up. And that's kind of what you're seeing from cryptocurrencies. They've absolutely collapsed. Bitcoin's gone from 128 to 60. I think it's going to head down to 10,000. And that's not very profound. It was about 6 months ago, and people got very emotional. I said it could lose a zero from 100,000. I said the exact same thing in 2018 at 10,000, and it got down to 3,000, so it's about 70% right. But the metals, let's remember what's happened. Everybody gets the fundamentals, but China is in a severe deflationary recession, completely dependent on fiscal and monetary stimulus and exporting to the rest of the world for recovery. We've seen this before in Japan. It took 30 years and it's still somewhat coming out of that. China's just starting to enter that post-massive expansion disinflation period. And so when you talk about metals, industrial metals, number one, talk about demand from China. How's that doing? Supply, obviously, we know most of it, metals are certainly silver and some copper from South America, and that's a little bit dicey. But like I said, the bottom line is any industrial metal, even gold now, because it's stretched, you have to hope that stock market will go up. And I'm really worried that at some point this year, we'll probably get a maybe 10, 20% correction. But we're still running equities here in the U.S. at 2.3 times GDP. That's the highest since the U.S. in 1929 and Japan in 1989. Now, people have heard that from me before. But I'm not out to throw water on people's fires, but I have to be a complete stoic strategist. And to me, the bottom line is the metals feel very similar to what I felt in cryptos last year. You have the sell side very bullish, trying to sell their ETF products. And then most traders, I think, get it that, yeah, you never want to buy gold when it goes this expensive. And typically, like I said, still think copper is a worthy short, particularly if it gets near $100 an ounce.
Yeah. Gotcha. You mean silver, $100 an ounce. Copper, I think. I don't know where's copper at on the ounce perspective.
The per pounds. I like to watch. I'm $5.78 is what I'm watching. Okay. I might have mixed up the two. My quote earlier in the year was above 6. I think is a worthy short. Now that's easy to say as a strategist. As a trader, you have to be nimble. Now that's a bull market. You don't just overweight a short right away and expect to pick the peak. You might be very nimble, or use some kind of derivatives or option strategy, which is more my mantra. But so far, 6 is holding resistance. And what if for copper, if you're sitting at a desk and you're long copper, you have a leverage position or any type of position on, I mean, I'm thinking from a trader standpoint, you first of all, number one prerequisite, you have to have that U.S. stock market goes up. If S&P drops 10%, which we're overdue for a 10% correction, God help us, but we're way overdue for that. It's just completely out of the system. Copper's going to drop 20%. So I think copper easily gets back to 5 and then maybe resumes the uptrend. It's still in an uptrend. I agree with that. But so was Bitcoin this time last year. Now that's in a downtrend. And I think I mentioned that because it's the leading indicator for all risk assets. And to me, this is what's happening. So what's happened so far we've had all the precious metals, certainly gold and silver, go parabolic and then have massive corrections. Huge volatility, potentially put in peaks for decades if history is a guide. We've had cryptos collapse. And volatility in the stock market might be just starting to pick up a little bit. It's early days. Let's remember, this is only February. So I look at this year again, the bottom line is we have to expect stock market volatility to stay at 8-year lows. And it's only February. So I think this is going to be a tremendous trading year. And I don't think people get it yet, and they won't get it yet until they get stopped out in their longs, that you can't just buy every single dip. So this morning, the chat on the Bloomberg chat, one guy typed in, congratulations to everybody who bought the 100-day moving average on S&P 500 yesterday. And I'm like, yeah, great. And then I quoted, yeah, it's easy. Just buy every dip. And that's going to get stopped out at some point. That's what's happening in cryptos. Cryptos led on the way up. For risk assets, I think are leading on the way down. So I'm bearish, honestly, almost everything except Treasuries. And I stated that earlier in the year. It's my mantra remains the same.
Okay, got it. So do you have a view on the S&P to gold ratio? So it made a
Yeah.
lower high after the 2000s, and it's been rolling over since
Yeah.
in gold terms. And so typically when that rolls over,
Yeah.
that means gold goes higher. And so just curious
Yeah.
if you think they're both going down together, like
Yeah.
both like the Rose and Jack in the Titanic, or what? Like what
There you go.
what's happening?
You got it. We hit the ladder. The lessons of gold is you're at a 50-year, almost a half a century extreme versus 60-month moving average, 200-day moving. You can keep lining them up. And everybody gets it. We all know why gold's up. But the key thing to remember about gold is you don't ever typically want to buy it after it goes up this high. So I think they're both going to go down. I think we're at the risk at the power of the margin call. So when we do finally get an S&P correction that drops 10%, I think we just hits everything. The bottom line is I've spoke to people in the last 2-3 weeks who've held gold and silver and precious metals, platinum and thing in accounts for decades, and the market for me and for them said sell me, because when it stretches this much, sometimes markets will tell you what to do. They'll tell you to sell or tell you to buy. I'm going to get super cheap. If you're not long already, okay, they mean buy. Bitcoin just had a good dip down to 64,000. That's a decent dip, but that's just support in a bear market. And to me, the precious metals told me to sell them last 2 weeks, and I'm sticking with that until proven wrong. So So here's the bottom line about gold. I took the pain in gold 2021, 22, and 23. McGlone called for gold to break above 2,000 every single year. I was wrong, Darrell, and it finally broke out. But now that it's broken out, just gone up too far. It's just the lessons of stretched markets in relative valuation and pylon. I was on a call this week, with Hong Kong late in the night, and I just love the Asians and Chinese are quintessential traders. I mean, they're some of the best traders on the planet for centuries, and this group was so bullish, precious metals, and their ETF showing all the great ETFs they're launching. It felt to me very similar to the same call I had last year about cryptos. Everybody's selling their ETFs, and we got retail piling on, and the prudent investors typically say thank you, no.
Got it. Okay, so I'm curious in your perspective on the miners. So obviously the miners have moved significantly alongside the metal, but now we're going to have these earnings calls where they are producing at a generally an all-in sustaining cost of $20 to $25 an ounce of silver and about $1,700 to $1,800 an ounce of gold. And so some of my perspective, which you feel free to push back on it, is that these miners are going to be printing cash at the current gold and silver prices. And so I'm curious if you have any thoughts on that.
Yeah, I don't track the equities as much. My main focus is the GDX, and we saw that's the VanEck Gold Miners ETF. And that is, if gold goes back to 4,000, it'll suffer. I think longer term, the miners, a different story. Longer term, it's always better to hold the equities. I mean, not always in gold, and typically in metals, because gold's been outperforming everything, potentially because central banks are buying. But my bottom line is, I don't watch the equities as much, and you make good points about the profits, but just look who's not on top of that trade now. So maybe you get a decent pullback and is a place to buy. I look at it right now as we've had a pretty extensive run, and prudent profit taking is more my bias, particularly in the underlying. The metals, the equities are more your space.
Yeah, got it. Okay. Are there any commodities that you are bullish on at this time? What do you think about oil? I mean, oil went down to the 50s, now it's traded. It's a sell?
So oil is bouncing a little bit on potential for geopolitical risks and potential for supply cuts out of the Middle East. Yet the whole price-making status on the global basis has switched over to the Western Hemisphere, led by the U.S., Canada, South America, Guyana, Brazil, Argentina, and now we add in Venezuela to that. Mr. Trump needs lower energy prices for the midterms. That's not very complicated. And then you look at the macro, the mean median in mode essentially last year was around 65 in TI. So far this year's high has been around 66, right? We're now at 64. That's the first place to be looking to be a responsive seller. So maybe something happens and we get some missiles flying in the Middle East and maybe there's a short-term supply cut and get to near 70. And then you look to be a more aggressive short. I think that crude oil is going to 40. I've made that call 3 years ago. I stick with it. I don't see see what stops that. Even though what's happening in natural gas this year. Natural gas has had a great trading year already. The bottom was 3 in the front contract. The high was around 7 in the front contract. Right now we're on 3.49. The thing to remember about the U.S. in terms of crude oil and natural gas is every time the prices go up, we have producers who sell forward, bring on more supply, and price goes back down. Those are enduring bear markets, particularly crude oil. It's an enduring bear market. It's bumped up. It's bumping up to the mean median mode for last year. The discipline in the trade is you're supposed to look to be selling that. That's what happened in Bitcoin in the beginning of the year. The high was 94, and just the low this week was 60. The prudent thing to do is to sell bear markets on rallies, but wait for those rallies. We've had a rally in crude oil.
Mm-hmm. Okay, so on the just because we talked about Bitcoin a little bit. So some people may push back on the Bitcoin position because Bitcoin has had 50% corrections in the midst of bull markets. It's corrected from 50%, 50%, then bounced and made new highs or similar to the highs again. And so, just curious. Is history something that should be factored in there?
Oh, sure, absolutely. But the difference is that the answers have changed. Bitcoin's in a bear market. I think it's going to 10,000. To be proven wrong on that, I don't know what's going to prove me wrong, but it's also proven that it's just a highly speculative digital asset. It's not the silliness that we heard last year from the sell side that it's pristine capital and leverage or digital gold. I mean, I wrote about it. This is what year is it? I wrote about this in 2019-20 that it was digital gold. I believed it, but it was 10,000. Now it's 69,000. So to me, it's going to continue low. And a key thing to remember about this space, I'll give you my outlook for when the low is going to come, is number one, when we purge some of the excesses in the 32 million Bitcoin wannabes. There was one in 2009. That was Bitcoin. Now there's uncoinmarketcap.com. There's an unlimited supply of cryptos. And you have things like Dogecoin. Dogecoin was launched as a joke. It is worth $15 billion. The high last year, not last year, in 2024, when President Trump was elected, was $60 billion. It tracks nothing, has no basis. It's going to go to zero, in my view. Same with things like Shiba Inu. It dropped around $3 billion. It's going to go to zero. You saw what just happened to XRP. It looks like it's breaking down. Well, you don't need XRP when you have stablecoins. What changed in the space is, number one, we've had the blow off top. Mr. Trump created that. Cryptos got trumped. I was getting bearish on the cryptos before he got elected. That stopped me out. But once he put it in, it made the market go too high, up too much, and a highly speculative asset class that has unlimited supply means prices should continue down. So I'm still bearish. I don't think there's much chance Bitcoin stays much above 80. It might get a bounce, and I think responsive, prudent thing to do is look at these sell bear markets on rallies, and Bitcoin and cryptos in our bear market.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Do you think these like Bitcoin and these cryptos, I mean, because like it seems like they build on top of like a new narrative every cycle, right? And the most recent narrative is like, this is the first time we have a United States president, championing the crypto and the Bitcoin market and starting a Bitcoin treasury and all of that. And so that was hugely bullish for the sector. But then now that the steam is let out of that bubble, it's like, okay, well, what's the next thing that could get high on? Because it seems like
exactly
that was like the height of the bullishness of what could be possible. And so I don't know if it's like a global adoption of Bitcoin or something like that's could be move it higher again or whatnot. I'm just curious on that.
Well, you made a key point there, and I want to point out the key thing. I've been bullish in cryptos forever, and that's the global adoption of crypto dollars. People call them stablecoins. I look at Tether right now. Tether's worth $185 billion. You look at Ethereum, it's $240 billion. I think Tether is going to flip in Ethereum this year, and that's not profound to say that, because Tether, when I first started really watching it, it was worth $2 billion in 2018, bringing Hong Kong back into the conversation. I was in Hong Kong in 2018. It was crypto winter, presenting with a bunch of people. And one thing they really pointed out to me and I got was, Mike, this is the first chance in history we've been able to get access to outside of our currency and get to something else via a phone. Now, then it was like tokens that track Bitcoin. You had to take a lot of risk and speculation. Now you can get to the dollar via stable coins and crypto dollars on your phone. That's what the Trump administration flipped. In addition, so remember Bitcoin, the Satoshi Nakamoto's white paper said peer-to-peer cash? Well, that's not really relevant anymore, because you can get peer-to-peer cash crypto dollars globally. And even XRP kind of loses its base case, when you have crypto dollars there. So the bottom line is that flipped. That mantra for Bitcoin is done. It's over. And also now the thing in the past was when I really enjoyed getting in this space in 2017 and getting bear. First time I really got bullish was around 2019, based on something that happened with Tether. We can dig into that later. But one thing that's really flipped now is people in the world, and mostly in the U.S., they love the fact that you can invest in a space to get away from the system, something new and different. You're not dealing with a broker or anything. You got something that trades 24/7 on a blockchain. It's awesome. That just flipped. Now, if you're a pension fund, an endowment, or any invested entity on the planet, investing in this space, what are you doing? You're supporting the Trump administration officials, and you're helping them pump their bags, because almost all of them are invested in. That doesn't usually go over well with most of these type of entities. They're a little less right-wing focused than that. So the answers have changed. The market's flipped. It's a bear market. It's over, in my view. To be proven wrong, I don't know. And also, the bottom line, if you buy any kind of cryptocurrency, certainly most of the main ones, number one thing you have to hope for for them to go up is the stock market has to go up, because they're so completely dependent on the stock market. So I published today, I really enjoyed publishing my outlook that we're going to look back from the future. Remember, we used tulip mania in the past? We're going to look at the crypto frenzy. Any measure in the future about markets going too high, instead of calling them tulips, they're going to call them cryptos. Again, there's still 28 million of them. Most of them have to go to zero, I think, until this place buys a bottom. And then I point out, what is a Shiba Inu other than the hope that someone else will buy higher?
Definitely. Shiba Inu is definitely something I would not park any money into. Even I have in the past, but I've sold since then. I've matured as an investor.
You did the right thing. You traded. It's fun to trade. It's gambling. There's nothing wrong with that. I've traded too. It's fun. I think I still have maybe $100 in my account. I just didn't care about it. Yeah. But that's the key thing. Remember what it is. It's a trade, and that's the bottom line. I'm glad you mentioned that, Darrell. I think the thing to look at is I look at this year as going to be an ideal year for traders. Come in, start to be as flat as possible, be responsive. And so far, to me, the responsive things to do were sell Bitcoin in that rally up to near 98 early in the year, sell copper in that rally, sell silver in that rally. And maybe buy a little Bitcoin recently at 64. That's been so far a decent little dip. Now we're at 69. But be nimble and be a trader. And then this bottom line, wait and be overweight treasuries. I think that's what's going to happen. I think the next big trade is going to be good old treasury bonds.
Okay, so I'm curious, and we can touch on this a little bit. We've already kind of covered gold, but you mentioned Tether. And so Tether's been taking stakes in royalty companies. I think they took a stake in Metalla Royalty as well as Gold Royalty. They've been buying gold. They have the token that's backed by gold. They also have been buying Bitcoin, and they still have a good degree of T-bills. And so you mentioned that you could see Tether flipping Ethereum. And I'm curious, like with them having a bigger focus on gold now and gold having moved significantly, do you see that impacting them in any shape or form?
Oh, yeah. Let's talk about pile on at the wrong time. The time to buy gold when it was below 2,000. Some of us have held it forever. When McGlone was wrong in 21, 22, and 23. Number one in 22. When Russia invaded Ukraine, I'm like, that's the trade. You want to be in gold. It stayed, I think after that happened, it dropped down to like 1,600. So I was wrong.
Yep.
Fine, that's the pain. Now we're in such extreme gain. The lessons of trading is you don't buy after extreme gain. So Tether, I don't know all that. Yeah, they have wonderful situation. The reason they're making so much money is because they can make all this money in T-bills. They're still making like 3.5% or so, 3.6% in T-bills. And on that 185 billion. But that's going to dry up when the Fed cuts. And what's going to number one thing to make the Fed cut, Darrell? They're not going to cut unless the stock market tells them by going down. And to me, that's what's going to happen. That's still my bias. And that's I'm emboldened to say it because I've been wrong forever on that. But I've been right on Bitcoin initially, and then I jumped off that horse in 2024 a little bit early. Then right on gold, I'm jumping off that horse this year off. And what's left? So. But the bottom thing to remember about Tether is it'll probably flip in Ethereum because Ethereum will go down, is the way I see it. Ethereum is right now around 2,000. Flipping, getting to around 1,500 means it'll be about the same AUM as Tether. And Tether's AUM is going to keep going up over time. I do think it's going to add a zero to its AUM over time. That's Tether. But then what's been the most enduring trend in all cryptos is Tether going from way down in the bottom of cryptos and just flipping in everybody, taking its time. It just keeps moving up. So I think by this time, at the end of the year, the number 1 and 2 cryptocurrencies will be Bitcoin and Tether in terms of, and Tether is obviously just a dollar token.
Yeah. Got it. Okay. So you mentioned the cryptos, they need the stock market to go up. And so I'm curious in your perspective on liquidity. We have a potential new Fed chair coming in. He was nominated. He has to get confirmed by the Senate, Kevin Warsh. Do you think he's going to be dovish? Some of the market says he's going to be hawkish. I know that interest rates are set by the board and not just the Fed chair. But just curious if you see I mean, you mentioned lower rates just a second ago, but do you see any type of quantitative easing or any type of liquidity coming in to like fuel this bubble even more?
Let's remember the number one catalyst for entities like that, our governments, to pump the system with liquidities is markets going down first. Yep. That's going to happen. I think the stock market's going to go down and the Fed's going to ease because of that. But Darrell, this is, may you live in interesting times. In our entire lifetimes, we've never had a stock market that's more expensive. And there's many ways to measure that, and it's overdue for correction. A lot of people know that. That's the thing that's what really got me really got me to focus on Bitcoin 5 years ago. It's like, it's a great alternative to the stock market. And certainly gold, it's a great alternative to the stock market. But those have both run their courses. The key thing to think about Warsh is, do you think Mr. Warsh is going to let history judge him as President Trump's lackey? No, he's not that dumb. Arthur Burns made that mistake. And the whole world knows that. Everybody sitting in that seat, as Mr. Jerome Powell realizes, I've got some responsibility here. And we all know at this time next year, Mr. Trump and lame duck are going to be in the same sentence. He's getting crushed in the polls. People are just getting sick of him as him. It's just the way he is. And he's got key things against him. Inflation. If stock market keeps going up, which he wants it to happen, if he keeps pushing against the Fed to ease rates, those are inflationary. That's a number one issue in all the election. So Mr. Warsh, I think, is not going to make a big difference. Yeah, and also, by the way, if he starts cutting rates, people are going to look at him as a lackey, right? Anyhow, and I think he knows that. So he's going to have a fun thing to navigate, but I think it's going to be easier because if the stock market goes down, it makes his job easier, and I think Mr. Trump gets that. So let's look at things that he really needs for the election. Number one, energy has to go down. I should have mentioned that. With crude oil bumping up to the last year's median mode, it's probably behooves him to have crude oil probably 50 or lower by the time we get the election. Right now it's 64. Natural gas probably behooves him to have it. By the election, it's pretty high because it's getting towards winter, but it's better for it to be lower. If there's ways he can make that happen, certainly in crude oil. Bond yields probably should be lower. That's the key thing why I still think bonds are going to be the best trade this year. It wants the Fed to ease, but keeping the stock market hot just helps those rich people. I mean, to quote unquote, that keeps inflation going and doesn't really help his constituents. Remember, that's top 10% of this country owns 80 to 90% of all stocks. They didn't vote for Trump. I'm from the in-between states. It's the heartland who voted really for Trump, and they don't care as much. They want lower inflation, lower yields, better mortgage rates, decent economy. That's okay. But again, all that matters is when you're 2.3 times market cap to GDP in the stock market, that is the stock market. And that's where we are now. We're seeing some good volatility, and I think that's what's going to happen. To me, that's the next recession. That plunging Bitcoin and gold going parabolic are telling me that the stock market's going to just drop 10, 20%, and that'll be our next recession. Now, when it's going to happen, I don't know. I think it's going to be this year based on what's happening in the precious metals. And we've just never seen this kind of rallies in things like gold with stock market volatility staying so low.
Okay, got it. Okay, so you mentioned bonds a few times, and I've heard this from different guests I've interviewed. So why bonds? Like many people in the gold space as well as the Bitcoin space, they're like, we don't want anything to do with the U.S. dollar.
Perfect.
U.S. is indebted. They're running fiscal deficits, and the budget was just raised for the military budget, $500 billion. And so why would someone want to park their central banks are buying gold, right? I think they hold more gold than treasuries now or something. So why would someone think about bonds? I mean, obviously it seems like a contrarian play for sure.
To quote Benjamin Disraeli, former UK Prime Minister, what we generally anticipate does not occur. That's why. Because the whole world's on that trade. That was the absolute right trade to be long gold and cryptocurrencies and things like Bitcoin the last 5 years. But now it's flipped. Let's give one example. The second largest economy on the planet is China. Their debt to GDP is around 300%. Their money supply is running, $50 trillion, almost double the U.S. Massive fiscal and monetary stimulus. And their 10-year note yield is 1.81%. In the U.S., as we speak, we're 4.21%. I think we're all going to go that way. So what you just said is not isolated to the U.S. Those are the known knowns, but let's remember what happens in deflationary environments after you've gone. It's called post-inflation deflation. It always happens after you get too much inflation. That's where China's right now. They're just trying to minimize it. And the U.S. is great, but it's what I love about being very bullish Bitcoin in 2020 when it was 10,000. It was very lonely back then, and I enjoyed that, particularly at Bloomberg. I mean, very, TradFi kind of company. Mm-hmm. Now we have Bloomberg Crypto and stuff. We didn't have that back then, but, I was kind of an advisor for that. The difference now is back then, Michael Saylor jumped on that trade. I'm like, thank you, Michael. You helped my bullishness. Now it's very crowded. And Michael Saylor of Strategy doubled down. It was an absolute long trade to do. It's called... I like to say never double dog dare the market gods, because the market gods will get you. And that's what happened to him. Now Michael's strategy, the high was one like 400, and the low so far is almost around 100. It's dropped, almost three quarters of its value. So the bottom line is everybody gets that. That's the mantra. I see it. But the key thing is if I look at a measure of, I'll be publishing on this on Monday, on the 9th. If you look at a measure of, say, TLT divided by GLD, it's the lowest in its history. Now, that only goes back to 2004. I go back to 1980, and the total measure of treasuries versus gold, that value of the price of those treasuries is the lowest since 1980. There's a certain time you see relative value, and you see people pile on the trade. They're piling on the wrong trade, and you're supposed to focus on the relative value. I'm focused on the relative value. And again, there's one simple little thing, Darrell, that'll happen. Just a little modest recovery in U.S. stock market volatility. Like I said, 180-day volatility around 11%. The average is around 18%. We get a little pop there, and we'll see what's going to happen. But it's the bottom line is think contrarian when you get to extreme levels. And we've had a great year already in silver. I mean, the range is great. We've had a great year already in gold. And I think they put in peaks. And every time I see that U.S. Treasury long bond drop around 5%, I think the market's double dog daring the market to go above 5%, because above 5% is a major draw for everything. If yields pop, everything falls, because that's a risk-free security. But don't underestimate, and of course, this already happened in Japan 30 years ago. Their bond yields went to zero and they had the highest debt. They still have a much higher debt to GDP, and their yields are still lower. So when people talk about bonds, think about bonds like that, think around the world. And basically, the U.S. is one of the highest yielding, deepest markets on the planet. And the bottom line for the whole world is anybody who's looking to buy any risk asset, you have to hope that U.S. stock market keeps going up, and the risk is it goes down, which to me leads to T-bonds. And I'll just end with this. There's been examples in my life. I remember 9/11. I was 2 blocks away, downtown New York, One Chase Manhattan Plaza. We had to leave our office. We drove to Chicago so we can work at our Chicago office for a week. I felt very comfortable being overweight long bonds then because the recession had already started, but that was for other reasons. Also in 2007-8, I remember I felt great being overweight long bonds and gold then too. But the difference now is stock market's more expensive than both those times combined, and gold's already had its run. So my point is, if you've been lucky enough to be overweight gold and to be bullish like I've been forever, you're supposed to be doing prudent book profits and look at something that's cheap, that no one wants, that has one good thing going for it, just a little back on the stock market and the bond. I think we'll look back from this year. When you and I are talking next year, if I'm wrong in this trade, that would be a substantial statement. We'll see if I'm wrong on bonds going, it means the stock market was fine and just kept going up.
Okay. So you mentioned right now on the long end it's 4.2%.
10-year, yeah.
Yeah. So I mean, some investors that doesn't seem sexy to a lot of
exactly
investors.
But I know where you're going. That's the key thing. There's certain years that you don't want to lose money. That's the way I'm defining this year. The bottom line is when you end the year at the lowest volatility ever with a very, very volatile and mercurial president who's running to an election. Obviously, he needs stocks higher, but he also needs a lot of things to go his favor. You go for the relative value, and that is, I think we're near the end game of this stock market rally. Crypto's collapsing, you've told me that. So I think basically the crypto market and Bitcoin got trumped. They pumped up on the massive, I mean, the things from his sons were just, we might make laws in the future to prevent presidents from investing in assets and his sons telling people to buy it and leverage their mortgages to do it. I mean, that's just somewhat scary. That's what's happened. And a lot of those people have lost a good portion of their investments. So that's what happened. So
I think the Trump coin got decimated.
Well, yeah, well, none of that, but crypto's got trumped. Now I think it might be time for stocks to get trumped. And the bottom line I like to end with is, it didn't matter to me, but before he got elected, my point was, I was hoping, maybe that distorted my view, that Kamala Harris would get elected, but my point back then last year was, whoever was the next president in 2024 is going to have the unfortunate situation of bad timing, very similar to Herbert Hoover. We are 2.3 times stock market cap to GDP, with the most expensive housing market and real estate market in history. And stock market is more expensive than ever. And just sometimes it just takes a catalyst for reversion. And then things tumble. And that's where we stand right now. And that's why I think by the end of this year, that's going to revert. And that's why I'm sticking with risk-off kind of assets. And gold is proven it's much too expensive, and that leaves treasuries. And that's also the thing, I don't give investment advice, but I've never heard a compliance officer or a risk manager say I can't suggest treasuries, because it's the basis for everything. And by the way, risk managers usually are invested too, and I always say to them, well, are you in treasuries? Because you should be. So.
Yeah, for sure. Yeah, I just wanted to share this real quick. This was pretty interesting. I had to go look at it. I remember when the Trump coin was launched, it went up to about $45, and then if someone's held that, it's at about $3.50 now. So,
well, that's also a key point. What happened with that? That's what I think really pissed off a lot of crypto peoples. That was just a profit grab from a very unique individual. Seems a little greed, but it's okay. I mean, we're capitalists, but that's what peaked the market. I think we're going to look back from history and say, instead of saying in all of the past we used to say tulip mania, we're going to say cryptomania. That peaked the market. This might last for centuries. This is how expensive we are. Let's not remember, this is a paradigm shift happening. And the bottom line for the whole world right now is that U.S. stock market has to remain elevated. We're going to go to a pretty severe recession based on one simple little fact: wealth destruction after the wealth creation.
Yeah. Well, thank you for sharing that, Mike. I got to have you back on the show as things continue to unfold. Things are changing very rapidly in this environment. So where can people connect with you, ask you questions, read some of your publications, connect the audience?
Well, I'm on your show. Thank you for that. I'm on X at Mike McGlone 11, on LinkedIn, Senior Commodity Strategist Mike McGlone. And if people want to reach out to me, I'll add them to my distribution list. I'm happy to do that. I publish usually once a day. Like today, my headline was Bitcoin's been trumped, yet our stocks, gold and silver next. So that's and I'm paid to have a view, so that's my view.
Yeah, appreciate you for coming on the show, Mike. Thank you for your time. And everyone, be sure to hit the subscribe button if you haven't yet. Love to have your support. And until next time, Mike.